Let me just bounce this off you, that Morgan Stanley thesis about stocks, especially the S&P, bouncing after the pause, but not exactly when we have an inverted yield curve, which we do right now. Agree or disagree?
Well, the inverted yield curve is definitely one of the signs, and perhaps one of the best signs of a recession. The inverted yield curve has predicted basically all of the last recessions over the last half century. And so, I think that's the worry for the markets is the Fed is being overly tight. We've been saying for a while the Fed's been overly tight. So we would like them to be cutting. Now the bar for raising, I think everybody is agreeing that the bar for raising rates further is high, but the bar for cutting might also be high. But our view, inflation is basically on its way down, and so the Fed should be cutting. And so the longer they stay too tight, that the more tricky, the deeper the recession could be. Now, for earnings, it's all going to be about earnings over time. People get pessimistic now, and at times as earnings are falling, and they fear the recession, and they apply a depressed multiple to depressed earnings. And we tell people to look past those depressed earnings to say what's their true steady state earnings. And the market's not overly expensive.
Wait, Jeremy, I gotta push back on one thing right now. You're talking about earnings, and a lot of people are worried about an earnings recession. But new data over the weekend, when it comes to the S&P 500 Q1 earnings, 75% better than expected revenue, 79% better than expected EPS. So if you're talking about earnings and we're seeing these kind of beats, what does that make you think about the market going forward?
Well, people have brought down expectations. So earnings are going to be, they were down last year. They're going to be down again this year. And so there's already sort of an earnings recession. And they sort of typically beat. They sort of almost always beat because people, bring down the expectations. But we're selling around 18 times the S&P 500 of this year's earnings. And so people fear that in a very doomsday, recession, you'll lose another $20 on the S&P, and then they apply like a 15 multiple to that.
Okay.
And that's where you get like a 3,000. That's what people get really pessimistic on. But we'd say in a recession, you can bring the multiples up. And, there's still a case that, productivity has been pretty bad. If we get rid of our less productive workers, maybe productivity goes up, margins stay fine, and margins go up. So that's sort of a bull case for looking past this recession.
All right, Jeremy, you mentioned a doomsday scenario. I want to talk to you about the debt ceiling because more and more the conversation about the debt ceiling is in a doomsday scenario. Is there any place you're recommending to clients that they should go to their portfolio and go for protection in times of volatility like this debt ceiling crisis that we're facing right now?
Well, you talked about the yields, and on those screens, there was very few things yielding over 5%. But what's fascinating about the current market is floating rate treasuries, which have a 1-week reset on what the yields are. I checked this morning; they're yielding 5.30, 5.30 when the 10-year is almost, it's significantly lower. I think you showed almost 200 basis points lower. Not quite that much, but the inverted yield curve makes that short-term treasury very interesting because the Fed is too tight. You're getting these extra yields in very short-term treasuries. So I love short-term treasuries more than ever in that sense of 5.30 on the short end. Now, the yields will go down with the Fed cutting later, but for now at 5.30, it's a very good place to be. And then you say, well, what could do well in a risk-off scenario? Gold is creating like bonds. It has some other features of people going to that if they fear different currency moves.